Hi, my name is John Cash. I'm the CEO and chairman of the board for Energy. Energy is a publicly traded company. We trade on the New York American Exchange as well as the Toronto Exchange. We've been in production at Lost Creek, our mine here in Wyoming, since 2013, and we're continuing to ramp up production after a bit of a hiatus when the price became so low around 2018. So we're continuing to ramp up production there. And we're very excited about our second mine that it's in the process of being built out right now, also here in Wyoming. It's called Shirley Basin. So that should be done with construction very late this year and online by early next year. That will take our licensed mine capacity up to 2.2 million pounds per year. We've got some great contracts in place, and our future is very exciting.
Good to see you. Good to see you indeed. Right, we're gonna hit a lot of topics today. I do want to get into your 2024 numbers. Also look at the assets specifically as to what's going on and what the opportunity is in 2025. But everyone's talking about the kind of political scene at the moment. U.S. tariffs, how that's affecting people. You're a U.S. operator selling into U.S. utilities. Is it affecting you?
No, fortunately, as a U.S. producer, it has very little impact on us. We're producing here in the U.S. We're largely selling to U.S. utilities, a little bit to utilities in Europe, but 100% of our deliveries right now, or nearly 100%, are here in the U.S. So even if tariffs are implemented on uranium, they won't have much of an impact on us. I would address supply chain as well with regard to tariffs, because we are building out a mine. And right now we're seeing very little impact from tariffs. We've already purchased a lot of the equipment. A lot of what we're purchasing is U.S. produced. We're a little bit concerned about electronics, industrial monitoring equipment, but we have found other places to get that equipment based here in the U.S. So far, tariffs have had little to no impact on us as a company from the production side of uranium, but also from supply chain. So I think we're in a great place.
Right, production side. For sure. But we've got other things afoot. Is it the cause of this kind of depressed uranium spot price that people like to reference all the time, or is there more to it?
Yeah, so certainly the spot price is not where we want it to be. It's not a bad price. We are beginning to see a little bit of upward momentum there. It's light, but there does seem to be some upward pressure there on the spot price. The long-term price continues to be very strong at around $80. We're extremely happy at $80 because our break-even price is much lower than that, around $45 as we get ramped up in production at Lost Creek, around $50 at Shirley as we get ramped up there. Economies of scale are very important. But yeah, I think some of that whiplash we're seeing from tariffs and other geopolitical things, it's putting the industry kind of in a situation where it's a deer in the headlights look. People are not sure where things are going to go, so they're kind of pulling back, waiting for things to settle down before they make decisions, and that's not been helpful on the spot price. But I would point out, and Matt, every time we talk, I talk about this, and I see other producers globally talk about this issue as well, and I would just have to chime in again that really the spot market is not where we sell product. We sell into the long-term market. Right now, we've got 7 contracts in place worth about 5.84 million pounds over the next few years. The vast majority of that is base price with escalation. So as inflation goes up, the price of that sales contract goes up. So we do have some exposure to spot, but we've got floors and ceilings on that. So we largely don't have exposure if the spot market would weaken from where it's at right now. We have a lot of upward momentum in those pricing mechanisms. So I think it's really important for your listeners to know that producers, legitimate producers, they sell into the term market. They don't focus on the spot. The spot market is incredibly thinly traded, especially over the last few months. And utilities, they spend most of their money buying in the term market. So always want to make that distinction and just fall in line with some of the other producers globally who trying to beat the drum on that mantra and get that message out.
Right, and just help me with the mentality of utilities. I mean, it's hard for you to speak to them, but you've got 7 contracts, and you do have conversations with them. But give us a sense of the pause for thought component of these Trump tariffs. I mean, why would they be slow down getting term contracts signed? Wouldn't they? Are they feeling at all pressured to maybe secure longer term contracts, more contracts at the moment, or are they biding their time? And if so, why have they got the luxury of time?
Yeah, I think it's maybe a bit of a mixed bag. I think some are biding their time. They think the tariff issue will go away. And I would point out that so far, there's not been a tariff on uranium production, with Canada in particular. So there's still free flow of that material into the U.S. without tariffs. So, but I think probably correctly, a lot of the utilities believe that this issue will go away. That perhaps probably even during the Trump years, over the next 3.5 years, that this issue will go away relatively quickly. Uranium won't be subject to that. So they're happy with the contract book where they have it right now. So they're not going to rush out and try to front end any tariffs or other geopolitical concerns right now.
Okay. I guess we could. Well, I guess the other factor was kind of driving this is Section 232, which a phrase I haven't used since 2020. 2019 time. What's the kind of latest news on this version, this incarnation?
Yeah, that was a bit of a shock to industry. It's certainly not something that the U.S. industry had been pushing. So we were a bit surprised on April 15th when the president put out an executive order that initiated a Section 232 investigation for critical minerals. That executive order explicitly included uranium as a critical mineral. So it directed the Department of Commerce to go out and within 180 days complete an investigation on the impacts of imports of critical minerals, including uranium, on U.S. national security. So what that means is DOC must complete that investigation fairly quickly. I believe that puts us about October 12th, that they have to file a report with the White House. According to statute, the White House then will have 90 days to take corrective action if they deem that that's necessary. And that corrective action, it can be a pretty broad spectrum of remedies. It can be trade. It can be regulatory policy, other things. Matt, if you recall in the previous 232 for uranium, the president decided to put together a working group of several agencies within the federal government. They came out with a paper that provided a whole list of actions that could be taken to enhance the nuclear industry in the U.S., not just mining, but conversion, enrichment, and utility energy production from nuclear power. And so of those 18 recommendations, some of those were implemented. One of those that was implemented was the development of a uranium reserve. And if you recall, the government put quite a bit of money into that to buy domestically produced pounds. We were the benefactor of that. We were able to sell some fairly high-priced pounds to the Department of Energy under that program, and that was incredibly helpful. So going forward, what's going to be the result of this 232? We don't know. It's covering a whole list of commodities. Critical minerals covers a lot of different metals, including uranium. So what will the ultimate decision be? It is really hard to know how that's going to turn out, but we're hopeful that we'll get some great remedies, maybe on the regulatory front, maybe on the trade front. But we'll just have to wait and see. It's a bit of an unknown at this time. And that unknown, people don't like unknowns. So the utilities, that may make them a little more reticent to come into the market. They may want to see how that plays out. So that's a fairly recent phenomenon. That was just literally a few days ago that came out. And so I have not talked to our utility customers since that came out to see what their response is to that. But probably not very positive.
Well, it's interesting. It's interesting. I think some critical minerals are more critical than other critical minerals. And when it's kind of bundled up together, you're unsure of what you're going to get. I felt like the last 232, there was some tipping of the hat towards it, but $150 million here and $50 million there. It kind of didn't feel like they were serious about it. Do you think they should or could take it more seriously this time around? It's government. We shouldn't expect too much, but delaying things till October on the part of the utilities, I can understand. But doesn't the utilities have bigger issues than waiting around for yet another decision?
Yeah, President Trump is far more sophisticated this time. In his first term, I think he just didn't understand very well how Washington worked. I think he's already demonstrated this term that he understands that a whole lot better. Love him or hate him, I think that is probably true. He's already initiated, I think, 4 other Section 232s for various commodities. So I think he plans on using that mechanism as a weapon on trade. He would not have initiated it, I don't think, if he didn't already have some remedies in mind. So yeah, we'll see where it goes. We'll see what the impact is on U.S. domestic uranium production, critical minerals production. There's quite possible that the utilities will benefit from this as well. If you look at the previous 232 of those, I think 18 recommendations, a number of them were directed at bolstering nuclear energy output. So we may see a similar result this time around. And I think, again, love him or hate him, I think President Trump is going to be more effective at utilizing that tool this time around.
Yeah, it'll be interesting to see for sure. Okay, let's kind of roll into 2024. You put out some numbers recently. I think the one that people are looking at is obviously the loss per pound in 2024, $6.19, compared to 2023, where you're making like nearly $31, right? Were those pounds equal? Are we comparing apples with oranges here?
Yeah, it's apples to oranges. I mean, we've been very transparent. We've had our struggles with ramping up production. We'll talk about Q1 here shortly, but yeah, we struggled through 24. We were starting to get our people on board. A lot of inexperienced people. We were not reaching those efficiencies that we needed to reach. And so production was fairly low in 2024. That forced us to go out and buy some pounds in the open market. Those pounds were relatively expensive compared to our produced pounds, and that's really what drove that loss. Happy to say, and many people have probably already seen the press release that we put out a few days ago on Q1, we're working our way out of that. Flow rates have come up dramatically. We are producing consistently now at a rate of around 400,000 pounds on an annualized basis. That's dramatically better than where we left 2024 production, and happy to report that that trend is continuing. Even though that report came out a few days ago, we continue to bolster that production. I think the reason for that is just a matter of training and confidence. Our employees a year ago, 18 months ago, they were brand new to the industry. High turnover, inexperienced, just a lack of confidence and ability in production. But that confidence is coming now. With training and time, people are comfortable with the decisions they need to make to bring that flow up, and we are. Likewise, in the processing plant, our capture of uranium is exactly where it needs to be now. So we're capturing an extremely high percentage. It's right in line now with where we designed the facility. And so our tail grade going back out to the field is increasingly, consistently very low. And right now we're averaging probably less than 4, probably less than 3 milligrams per liter going back out to the field. And we'll continue to make improvements on that. But where that translates is to a lower cost of production. The more pounds we produce, we get into those economies of scale that are so important that our shareholders hear me talk about quite routinely. Is we've got to up that production to get into those economies of scale. And we're getting there. We're on a great trend. We've got our people, we've got our drill rigs, we've got 19 rigs at Lost Creek. We had 21, but we took 2 of those rigs from Lost Creek. They are working over at Shirley Basin now, installing wells there, and we'll bring on about 4 more contractors for drilling over at Shirley Basin here in the coming months. So not completely happy with where we've been, but increasingly happy with where we're going in driving that cost down.
Okay, so the ramp up moving along operationally, I see for reasons that you said, looking good. In terms of strategically, in terms of the types of contracts that you tie yourself into, is there what have you learned there? Because it kind of feels, because I think Encore we're in the same position with having to go into market and buy more expensive uranium than they were producing and selling it, and they had a bit of a loss there as well. But what can you do strategically with the kind of the utility agreements that you put in place to protect yourself going forward? Any lessons, I guess, is what I'm asking.
Yeah, no, Absolutely. I would say that the utilities have been incredibly good to work with. There's a shortage of supply. The utilities want U.S. production where they can get it. And so because of those factors, when I've called them up, one or two of them, and said, hey, can I move this around a few months here? Can I move that around a little bit? They've been very agreeable. They've been incredibly gracious. They've been very supportive of UR Energy. And so as we continue to ramp up production, we remember that, how good they've been to us, and we're going to get them those pounds. We're going to be a reliable producer. But that's one of the lessons learned is, maintaining those relationships with your utility customers. They are so important. It is such a small industry. There are not many of us producers out there. It's a very small world there. And it's equally small on conversion, enrichment, and the nuclear power plant side. So you go to a conference, you can meet with pretty much everybody in North America in one conference. And so we have to remember that and be a reliable producer. So going into 2025, where we are right now, our contract book for this year is 440,000 pounds. Right now, we've got a great inventory at ConverDyn. We have growing confidence that we're going to be able to provide those 440,000 pounds to our customers. And then going into early next year, we'll have a second mine coming on with Shirley Basin. So that helps us diversify the risk, brings up production. We're seeing some great things at Shirley Basin with regard to flow rates and grades. And we're beginning now to put in the production and injection wells. And we're on target there for construction. We've done so much last year and early this year. It was a very good winter. So we were able to work through most of the winter out there without plowing the roads. And so we've got several of the buildings refurbished. We have done compaction now, nearly finished with that for the foundation of the satellite plant. Roads are in, power lines are in, monitor wells are in. We've hired a lot of people already. I know that's one of the concerns that investors have is, can you get people? That's industry-wide. That has been a major challenge, not just for UR Energy, but I think you talk to any of our peers globally, that has been a challenge, is getting experienced people. But we're happy to report that recruiting for Shirley has gone extremely well. We've got most of our senior managers now at the site. We've got, I think, about 10 of our hourly staff at the site. And going into summer, we'll be bringing on more people, and we'll just continue to build that, train, so that by no later than early next year, we're going to be ready to go. And we maintain our schedule for that.
Right. And how, okay, you talk about optimizing things operationally. And obviously, as people learn, they're getting more efficient. You're retaining people. I say it's a big issue. It's a big issue in the space for everyone. What are the kind of measurements or the KPIs that you put in place to sort of track the performance, not just in terms of pounds, but if they're going efficiency of and cost of those pounds? Because I think when you're ramping up, it's like you got to focus on the output and production. But are you able to kind of look at the kind of efficiencies at this point, or does that come later? How do you measure all that?
We look at that every day. I mean, there are a couple of broad KPIs that are the most obvious, and that's cost per pound and pounds produced. I mean, those are the two the KPIs kind of at the end of the equation here that are essential. But when you look at the micro scale, some of the other KPIs would be, what are your flow rates per well? What are your total flows? How many header houses do you have online? What is your percent recovery in the plant? Those are all key performance indicators that we are looking at literally every day, if not multiple times a day, to see where we are. I would also add, maintenance. What is up and running in the processing plant and in the field? Is your maintenance department keeping up with the needs there? For example, the dryers are a key component. We have 2 dryers at Lost Creek. Are they both up and running? And they are, but that is a KPI. Got to have those guys up and running, ready to package those pounds. It doesn't matter how many pounds you bring in from the well field, from the mine. If you can't process them in the plant and push them out as finished product in drums, then it's all for naught. So those two components have to work with each other hand in hand. The mine has to work with the plant and vice versa to produce those pounds We're all in the same boat. We all have to perform together.
Right, and obviously because it's all relatively new in that sense. You're one of very few producers, one of a handful, and certainly for North America, there's not a lot of pounds being produced as well. So, given you're new, looking at some of those KPIs, some of those benchmarking that you're doing, things like the current head grade and flow rate benchmarks that you've got. Have you started to work out how sustainable they are and why, and does that affect the way that you target your drilling going forward on the expansion side?
Yeah. So we're really happy with head grade. Head grade continues to be pretty high, and that's been pretty common and sustainable at Lost Creek all the way since 2013 when we initiated production. Once we started to get ramped up, we've had great head grade there. That's something that not a lot of our peers enjoy. So we continue to appreciate that great head grade. One thing where we did struggle a bit was with the overall number of wells that we're on. And that's where that experience with our employees comes in. How do you manage that? How do you maintain that? When pumps break down, how do you prioritize which ones you go out and repair? So maintenance is a part of what we all do. Just we've got to do a better job. But we're seeing that tremendously improve. Yeah, it's sustainable. I believe the increase in flow is going to be sustainable for quite some time as we continue to ramp up. The last few weeks, we've increased our flow rates as we've had a great spring. We've increased our flow rates by over 44% now. And we've got a long ways to go there to continue that. But yeah, we've got the people, we've got the equipment, and the growing expertise to be able to do that.
Right. And will you target internally, or will you issue guidance with regards to this kind of average cost per pound that you talk about? In 2023, it was about $28 or so, somewhere around there. Last year it was not that. So if you got a target in mind internally, is that something that we could use to, judge you by going forward?
Yeah, so I would encourage the viewers to take a look at our technical reports for Lost Creek and for Shirley Basin. If you go to our website, the very top center, there's an icon for tech reports. Pull that down. It gives a full economic analysis. We've reviewed that analysis very recently, and we believe it is still accurate. But for Lost Creek, as we ramp up production and flow there, we're looking at $45 or so a pound all-in cost. For Shirley Basin, we're still looking at around $50. So we've got to continue to ramp up that flow. We have to continue to perform as we've been performing in the processing plant, but that's we're sticking by our guns on that as we ramp up production.
So just coming back to the point I made earlier in terms of apples and oranges, why was that number a lot lower in 2023?
Economies of scale, real simple. There are a lot of fixed costs in any mining operation. In situ mines are no different. So we need to overcome those fixed costs, things like land holdings, insurance, electricity, all of those things, regulatory oversight, which is not insignificant in the nuclear industry. Those are all fixed. So it doesn't matter if you produce 1 pound a year or 1 million pounds a year, those costs don't change. And so that's why those costs were so high. And then we had to buy pounds. But we've got to get up where we ramp up production. So we're not buying pounds. We don't anticipate going out and buying pounds beyond any existing commitments in 2025. But that will also give us some great economies of scale as we continue to ramp up. So we should see our production cost decline going forward.
So remind me, for 2023, then the production you're saying would have been, what, in terms of economies of scale, where was it coming from?
Oh, just 23 was really our first full year of production for ramp up. So our production rates were incredibly low. And that's why the costs were high that year. I think the investing community appreciated that. They weren't expecting miracles in 23, but going into 24, we didn't meet our targets there. But going into 25, we're headed in the right direction.
Okay, fine. And then with regards to how you think things, I'm just sticking with the operational stuff at the moment as well, because I think as people appreciate that you're producing, and two, very few people producing at the moment. So there's a lot to be lauded there. But you've got some 2025 delivery commitments. You've moved some out to 2026. And then you've got the uranium loan repayment component as well. How do you feel about your ability to deliver against all of that and cope with all of that?
Yeah. So this year, increasing confidence. I think we're in great shape this year. 440,000 pounds for delivery to utilities, loan of 250,000 pounds. That loan we're discussing internally. Do we want to extend that, or we want to go ahead and pay it off this year? The terms on it are very favorable, so we may hang on to it for just a touch longer. Going into next year, the contract book increases fairly dramatically. We're up over 1.2 million pounds delivery next year. So we'll continue to ramp up flow and production at Lost Creek this year. Got a little bit of a grace period there to be able to do that, and then bringing Shirley Basin online next year, producing hopefully at no less than several 100,000 pounds there at a facility with a demonstrated extremely high flow rate. And we'll call on those flow rates to bring in production fairly quickly there. At Lost Creek, the back end of the plant is up and running. It is ready to receive those pounds from Shirley Basin. We'll take ion exchange resin that's loaded at Shirley, truck it over to Lost Creek and process it there. We're ready to receive that. The dryers are up and running. Filter presses are working. Precip's working. So we're ready to go there. But those two mine sites combined, the production will allow us to feed into those contracts.
Right. Okay. And how many rigs have you got deployed at the moment? And how many wells?
Yeah, 19 rigs turning at Lost Creek. That's what we need. We're happy with that number. We're not looking for any more. For Shirley Basin, we've got 2 turning there, and we'll be bringing 4 more rigs on later this summer.
Okay. And will you look to kind of redeploy those as Shirley Basin starts moving towards inevitable production, or would you just bring additional rigs on top of the 21
There'll be
already?
additional rigs. We've already got them identified. We're talking with the owners, contracting them right now. So we've got them locked in. In our previous conversations, Matt, we talked about the short supply of drill rigs. To be more clear, it was never a shortage of drill rigs. It's always been a shortage of people to operate the drill rigs. Supply-demand fundamentals. The demand for rigs was there, but the supply couldn't satisfy that demand. That's been a challenge for us and a number of our peers in the Rocky Mountain West. But with time, the drill companies have been able to find people, get them trained, and be able to bring more and more drill rigs into the industry, not just for us, but for some of our peers. So I think the drill rig issue is, don't want to say completely behind us, but I think is largely behind us going forward. So when we call up the contractors now and we say, hey, we need 3-4 more rigs, they say, yep, got them, got the people. When do you need us? So it's an easier conversation now.
Okay, talk to me about these margins again, because people go, ISR, it's cheap, it's the cheapest form of you're mining for uranium, drilling for uranium, but you're outlining somewhere between mid-40s and $50 all in costs here. Do you think you've got the ability to kind of drive that number down, or do you think that like we've seen in a lot of mining metals across the world, people kind of get used to a new paradigm? These are the real world costs now, even in ISR. So again, how are you viewing costs at the moment?
Yeah, those cost estimates I gave you are there in today's dollars. So would love to be able to say, yeah, we're going to drive those down. I think there's a little bit of opportunity. If we maximize production, we take it right up to the license limits at Lost Creek and Shirley Basin. Can we drive them down marginally? Yeah, I think we could, but we're fighting against inflation too at the same time. Fortunately, our contracts all have inflation provisions built into them, so we don't really feel the impact of inflation on our contract pricing. But yeah, Matt, it's going to be difficult to have much improvement there when we're fighting against inflation going forward. But we'll see. We've got some great engineers, some great geologists, great ideas on how to enhance production. Shirley Basin is interesting. We're seeing incredible flow rates there from some of the injection testing that we did very late last year, very early this year. If we're able to capitalize on that like we want to, that remains to be seen. We're not going to model that yet until we actually see it in production, but that could help us drive down our cost there. It's a bit of an unknown. I don't want to overpromise and under-deliver on that, but it is something really interesting that we're watching very closely, and that may require us to go out and redo our tech reports in the economics for Shirley Basin. We're not going to do that, though, until we have confidence that that's really what we need to do.
The only reason I ask is I've seen this in the last couple of years in a still an inflationary environment where companies who go through the development phase and do their economic studies put out numbers which bear no resemblance to the real world numbers being faced by actual producers, whatever the metal, right? And it's very easy when you're sort of sitting in a kind of desktop study phase where you can make assumptions which bear no resemblance to the realities of doing business, and your numbers look great. But when you get into DFS phase and all of a sudden the numbers dramatically change, people get shocked. And that's why I'm kind of pushing you on this. I'm trying to say that you're one of the very few producers, and that's a really big deal. People don't realize that, because when it comes to not just the final economic study, but the actual reality of that kind of ramp up and seeing what it does to the numbers, it will dramatically change the story for a lot of companies out there talking a good game at the moment. So yeah. Any reason?
Yeah, no, it's interesting. We see that a lot. We have to chuckle every once in a while when we see numbers on estimates for capital expenditure to build out a new mine, and then operating cost. Sometimes, and I'm not going to name names, sometimes those are old facilities that were shut down, decades ago because they weren't economic. All of a sudden, a new sheriff comes into town and says, we're going to put this into production at an incredibly low cost and very low capital. And we just kind of shake our heads and we say, those were some pretty smart people back in the 70s and 80s, and they couldn't make it work economically. But all of a sudden, we've got a new person here that thinks they can. And by the way, they've never produced a pound of uranium economically. So we just chuckle and we just let time run its course. But I think there's a bigger story here too. Supply demand. Right now, supply is not keeping up with demand. And I don't think it's going to for a while. We've got a lot of companies out there making grandiose promises about what they can do. I don't think a lot of them are going to be successful. Some of them will cut their losses before they go into production. Some of them will try to go into production and fail there. But ultimately, I think a lot of the promised production is not going to be there. And it's going to take pricing. My estimation is another $10 to $20 in the term market to be able to incentivize that production going forward. I think Cameco is a perfect example. They are a very well-established, very well-run company. And despite prices being at 80, are they running out and trying to start up new mines? They're not. And I think that's telling. I think other people in the industry can learn some lessons from that. Investors can learn some lessons from that as well. Prices need to move higher to incentivize new production. We're not there yet. I think this bull run, we are still in a bull run. The long-term price is at 80. That's a fantastic price. But I think we're going to have to see even higher to bring in those prices, to bring in those marginal pounds to balance supply demand.
I think it's a real problem. I think some of these uranium portfolio companies, not all their projects stack up, but they're all being valued the same as the best potential asset in the portfolio, and it's going to be huge value destruction at the point they have to. Well, I guess the rubber hits the road, and they have to actually do what they say they've been doing. Term contracts aside, that will protect them for a bit, but at some point, if this starts moving, they're going to have to get moving. And I think we're in for a bit of a shock. As you say, the supply is not as advertised. There's not as many pounds advanced at all. So I'm with you. I hear you. Okay, so it sounds like you kind of got the team, you got the process in place for Lost Creek and Shirley Basin for next year. In terms of that, do you need to hire more people, or is it a case of rotating the people around us as Shirley Basin comes on board?
No, we pretty well have our people at Lost Creek.
Yeah.
We'll continue to have a little bit of turnover there, so we'll hire onesies and twosies here and there, but largely at Lost Creek, we're in great stead there with the people we have and the growing understanding of in situ out there. Shirley Basin, again, we've got our senior management pretty well in place. We've hired about 10 people there for hourly staff as we're beginning to drill there and install wells. We're relying on outside contractors to build out the satellite and do some of that work. So we'll be hiring, don't hold me to this, about 40 more people, hourly staff, 50, somewhere in that range for Shirley Basin. We're not going to start that quite yet, but we certainly want to get it done by late summer, early fall, begin to train those individuals so that when we do begin production, no later than early next year, they've had boots on the ground, they understand the process. We'll likely do some cross training over at Lost Creek because the well installation, piping, monitoring, all of it is the same as at Lost Creek as it will be over at Shirley Basin. So really no difference there, but we'll use that as a training ground so that our new staff at Shirley Basin, they're ready to go when we ramp up production. We will also need to do a pre-ops inspection at Shirley Basin. That's a requirement from the state of Wyoming. We're already beginning to assemble our records, procedures, permit documents, all of that. We're hoping to go ahead and get that in front of the regulators sooner than later so they can go ahead and give us the thumbs up on that, the paperwork side of things, so that when they come out and do the physical inspection late this year, early next year, all it is a matter of verifying that we constructed in a manner that we said we would, and it's an easy inspection, and we get ready to go and able to fire up a little bit more quickly because of that efficiency.
Okay, that's the uranium recovery program.
It is.
Okay, so that's not expensive. It's not time consuming, and it's not a hold up for you. It's a process that's well understood.
Right. Yeah, we've been through that process before, and the regulators have as well.
Okay. Well, John, thanks very much for coming on the show. Thanks for also explaining, the 2024 numbers, and more importantly, what you're going to be doing in 2025. Looks like there's a lot to do, but into a very exciting market for the very few producers out there. So appreciate your time today. Thank you.
All right. Thank you, Matt. Appreciate the time.